Hi, and welcome back to Channel 11. I'm your host, Ken Shinoda. Today is Thursday, February 24th. I've got with me Robert Cohen, Director of Global Developed Credits at DoubleLine. Robert, good to see you in person, not on Teams calls, which is kind of like the Zoom we use at DoubleLine.
Thanks for having me.
Of course. We're here to talk about the bank loan market and opportunities in it. We thought we'd have a nice, peaceful morning, but unfortunately today we have this crazy news of the invasion of Ukraine by Russia. So we're still going to talk to you about opportunities in the bank loan market, but we'll have a spin on how volatility can create opportunity and how our portfolio management and credit teams at DoubleLine try to take advantage of those opportunities. Robert's prepared some slides to walk us through how he thinks about the market. So Robert, I'll turn it over to you and let you drive the show.
Okay, great. I think you have to start with where we are in a macro environment. Putting aside tensions in Eastern Europe for now, we're in an environment where we have, you can see on the slides, above average GDP growth. It's slowing, but still above trend, and that's an environment that's typically good for credit holistically, because a strong economy means earnings are growing and companies are doing well, and that's an environment where you want to own credit. When this starts to slow down, then I think you have to have a different discussion. But for now, it looks pretty good. The next slide I have is about inflation. This is CPI, the hottest topic of our era right now. And clearly, inflation is running hot. The Fed said it was going to be transitory last year. It turns out it's not transitory. It's anything but that. With this flare-up in Ukraine, that's now we're seeing Brent above $100, yep. WTI almost touching 100. That's not going to help inflation go away. That's going to make inflation worse. And so this is a problem for the Fed. They have a plan to, finish QE and lift off in raising rates imminently. They're going to be challenged now with the market volatility and with what's going on geopolitically. So they're going to have to navigate that. But rates that probably will continue to stay on plan to raise rates. We can have a long debate about how much, but that seems to be coming no matter what.
Surely short-term rates are on the rise.
Absolutely. So the next slide here. So we can debate how many hikes happen. If you look at the bond market futures, it suggests there's going to be over 6 hikes this year. I'm going to go on a limb and say I'll take the under on that, given all the macro volatility that's going on. I don't know that's going to be 0, but I think doing 6 seems quite aggressive, seeing where the pressure you're seeing in the equity markets and other risk markets, and then, like I said, the geopolitical issues. But in any event, rates are rising. The Fed is going to hike, and you have to think about, what assets work in that environment, which is basically why we're here, because we're talking about bank loans, which are floating rate, that do well in a rising rate environment.
And they have been one of the best performing assets this year. Finally, the index turned slightly negative a few days ago, but compared to many other parts of fixed income, deeply in the red, negative, 3-4% for higher quality assets. Corporate bonds down over 5%.
Right.
So bank loans are basically barely down on the year.
I mean, you can boil it down to you want to be short duration. So any assets that are short duration are going to put you in the best position to win given the macro environment. So if we move along here, just to give people an introduction to the asset class, it's bigger than a lot of people think. It's about a $1.4 trillion asset class.
Way bigger than before the global financial crisis.
It's grown substantially, which you can see. In 2005, it was sub 200 billion, and now we're at over 1.4 trillion, so growing substantially. It is a very diversified asset class, which I think is important. It's not a thematic bet on one particular sector. It's basically financing all across the U.S. economy: healthcare, technology, industrial. It looks like the U.S. economy.
And high yield is more overweight in certain sectors. I know it used to had a lot of energy exposure at one point in time.
Well, that's changing too. It used to be upwards of nearly 20% energy in high yield. Now that's probably 10%, but it's still a significant component of high yield. Bank loans now are, the largest sector is now technology, which coincides with our economy now that's becoming more digital. So in a way, the loan market is sort of kept up with what's happening in the real economy by rotating into more tech and healthcare. Healthcare is also a large sector of both the bank loan and high yield asset classes, which sort of makes sense because healthcare is growing, it has inflation, there's ways to make money. There's ways to make money in the transition to digital records and things like that. We can talk about specific opportunities, but those are growing sectors.
So for you as a portfolio manager, you have a lot of choices, a lot of places to go to express your views and position appropriately for the environment that you see coming.
Absolutely, I think that's the key thing. So you mentioned energy. Sometimes you want to own energy, sometimes you don't. Now you clearly do. But both high yield and loans, there's the clear opportunity to kind of pick what you want and put the positioning, risk composition you like based on your outlook for the future. So I think we talked about that. I think we'll move on and talk about fundamentals, which is something that people want to talk about given kind of the macro backdrop. One thing that comes up is interest coverage. So if rates are rising, doesn't that cause greater interest burden on companies? Can they handle that? And the short answer is that we are at nearly all-time high levels of interest cushion, meaning the amount of free cash flow to their interest burden is nearly at a record. And so that gives a lot of cushion. I've done some sensitivity we can get to in a bit to see like what happens if rates rise 100 basis points or so, and we can look at that. But the short summary is that there's a lot of cushion and there's room to absorb that for now. We do have to mention that leverage is high, so I'm not going to sugarcoat things. We're at a point where we are coming out of a big reflationary moment in credit starting in the middle of the pandemic, middle of 2020, and leverage is high, and that's where credit selection becomes critical. This is the moment. This is not a beta trade anymore. This is not a reflationary trade where you buy everything. This is the moment where you pick individual credits that you think will perform well in the environment we're in, which is, let's say the second half of an economic cycle with inflation, with rising rates. Some stuff will work now. Some other companies will not work so well, and it's about picking the spots. And I think that's a key point to mention.
Makes a lot of sense. And how does it look today versus the last time we started raising rates, kind of in the 2017-18 time period? Things look better today than they did then from a fundamental standpoint. Right?
Yeah. Let's hold off on that for a minute because I have a slide to get to it. We're going to get to that. Actually, this slide will help. I think what this slide tries to show you is that people worry about interest coverage. What you really need to worry about is growth. So loans are really a pure credit product. If the economy is growing and earnings are growing, then that's going to paper over a lot of issues. So interest rates are one issue to worry about, but we have to worry about inflation, so raw material price increases. We have to worry about labor costs going up. There's many pressures in the economy that can squeeze margins. If the economy is growing slowly and EBITDA earnings can't grow, you can't cover these inflationary costs. So it really boils down to what is your expectation for earnings growth for the next year and two, and that really should set the table for how you like credit and where to pick your spots. Okay. So what this slide basically shows is that if EBITDA is growing, it's quite simplistic in a way that interest coverage goes up because you have more cash flow. I think the reason I wanted to pause on your last question is if you look at, I'm going to point to 2019 as an example. You look at 2019, the yellow, which is EBITDA. I have a better slide, but we can just use this one. You can see EBITDA was going down. The growth rate of earnings was decelerating. So when you think about when is the time that's okay to invest in credit and when do you have to start on the alarm bells, you need to start worrying when that deceleration happens, which we're not at that point. We're at the spike where EBITDA is growing. Now it's going to come down, but we're a long way from that trough that happens over time.
Yep.
So I think that's the big point, is that when people ask, is it a good time to invest in credit? Is it a good time to invest in the stock market? Is it a good time to invest in any derivation of risk assets? Well, it depends where you are in the growth cycle. If growth is decelerating, that would be the time to sound the alarm bells. We're not anywhere near that right now.
Sure.
And so just to touch on it again, this is another example of how to look at interest coverage ratios. This is work done by Morgan Stanley. And basically what they do is they say, let's say EBITDA growth is flat, which isn't true. EBITDA is growing, but let's say we're in an environment where earnings are flat and rates rise 100 basis points. Because we're at this high level, even with the deterioration in coverage due to the rise in interest rates, we're still going to be well above the trough interest coverage ratio that we had post financial crisis at 3.5. So there's plenty of cushion. I think that's the bottom line here. So really, I don't think of interest coverage as the key thing to worry about. It's like I said, is the economy growing? And
Yeah.
are companies going to grow earnings? That's really what we need to think about. And so I'm going to move to another slide that just kind of points this out in a little bit more clarity. You mentioned 2017 and 2018, we had pretty stable growth. We didn't have the high growth period of, double digit, but you had a long period, really, this goes back to 2015, where we had double digit growth or high single digit growth. And that is an environment very conducive for credit. So if we have that kind of growth and that sustains itself, credit will do very well. I contrast that, and don't forget, we had in the end of 2015 into 2016 a bit of an industrial-led slowdown. Worry about China, worry about the U.S. economy slowing down. We did have a slowdown, but from 16% growth down to 7%. I'm talking about in the loan market. This is EBITDA growth.
Yeah.
So double-digit EBITDA growth in the loan market down to 7%, but 7 still very good.
Sure.
So if we have a slowdown now in the environment we're in now from 20% growth to 6, 7, 8% growth, that's still pretty darn good. What I would be on alert for is what happened in 2019, where we went from double-digit growth to high single digit to low double digit to 0. Like that, that trajectory is pretty worrisome.
Even if you threw the first quarter of 2020 out because you'd say that's COVID, like
the line is not the trend is not your friend.
Into 4%. Yeah, that's one of the lowest points I see here on this chart, outside of a blip in late 2016, right?
Right, exactly. So that's what to be on alert for. Default rates are very low. So thinking about other indications of credit quality, the default rate is nearly 0. And so if you have growing earnings and a low default rate, that's a good environment for credit. Another indication that I think is important to point to is, like, where is the stress happening? So we have this stress in the bond market. Where in corporate credit are you feeling the pinch? Long duration assets. Investment grade is the worst performing part of corporate credit. High yield, like, where are you suffering in high yield? In the double Bs, long duration, low coupon double Bs. So
longer, not necessarily
longer,
that long,
not as long as you're talking 4 or 5 year duration,
Sure.
not a 7 or 8 or longer duration. And so that was what's been feeling the pressure. Triple Cs are outperforming. Triple C high yield is outperforming. Triple C bank loans are outperforming.
Yep.
So if you take that performance in the weakest credits in a low default environment with growing earnings, that makes me feel like we're okay. This is an environment that's good for credit. Now, you have to think about the environment, what works and what doesn't. Well, I don't want a credit that has high sensitivity to inflationary pressures, that has high sensitivity to wages that they can't pass through. Some companies can pass through wage inflation, some can't. And so these are the conversations we're having internally. Like, I want to steer clear of those situations.
Sure.
But there are credits that will do quite well in this environment that maybe are a little softer than they were. I mean, just to mention one, so we can actually tell like a real live example. There's a company called Medline that is a distributor of medical supplies. So IVs, syringes, all the kind of low-tech stuff you see in a hospital.
Sure.
Well, people still need that. They're still consuming that stuff. That is a best-in-class national distributor that I think the expectation that's going to be investment grade someday. It doesn't matter what's happening on the macro front, whether earnings are slowing, whether inflation is raging. Like, people need this stuff. People need their medical supplies. It's going to get supplied. You can get a loan there with a 4% coupon at a discount, and the unsecured bonds are in the mid sixes with a pretty, I'd say low 90s price. So you look at that and you say, here's a company that will survive. You don't have to make a prediction of where the markets are going, but you're getting discount, you're getting coupon in a company that will eventually be investment grade and is in a sector of the economy that is not going to be, sort of the bullseye of the pressures we're feeling now. So those are the areas that we like, that we think you're supposed to lean into and steer clear of the credits that are subject to the inflationary pressures that we've been talking about now for a little while. I think that trade was something you had to do last year. It's kind of like in COVID. When COVID hit, if you owned companies that were affected by COVID, transportation, gaming, hospitality, you couldn't get out. It was kind of like it was too late in February of 2020 to say, you know what, I'm going to reduce my airline exposure. You already got hit. It's probably a little late now to say, I'm going to repopulate my portfolio to consider, the inflationary pressures that are out there. I think a lot of the damage in many ways has already been done. So if you're in a position where you were thinking about this last year, you're probably performing better than those who kind of ignored this.
Sure.
And so I think that puts us in an environment where if you can do that work, if you can do the bottoms-up name-by-name analysis, you can put together a portfolio that does well in this environment.
And on days like today, although it doesn't seem like the bond market's down too much on the credit side, that's when you can, if you have this list of names that you like, you can buy them on these dips to the extent that we see some of this volatility.
It's all about having capacity. It doesn't matter what asset class. If you own too much and it goes the wrong way, you can't buy more. So that's why being conservative when spreads are tight, to have a very diverse portfolio without making big bets on any particular name or sector, gives you the flexibility, which we do. We want to be more diversified. Last year when spreads were tight, now that spreads are widening, we have the capacity to lean into things. That's the key thing. If you're full already and then the backup happens, there's really nothing to do. And that's why you want to leave yourself some capacity. So this is an environment where you really make money by trading volatility. It's having a clean portfolio before the volatility hits and then leaning in when the volatility presents itself. And then the discipline, which is hard to do, is when it starts to run. You have to trim it again because until we're in a reflationary, everything works environment again, you're going to have to start trimming again because you're going to have another downdraft. And that's the discipline, which requires sort of like that's just a daily come in and grind through your names and make sure you know what you own. And if it's run up 5 points and the market's hot, like everyone's feeling good, maybe it's time to start trimming again. So,
okay.
One last, I'm going to skip over a couple slides because I think there's something important that I'd point out, which is that this shows the performance of the bank loan market since 1998. And what it indicates is that there's only been 2 down years over that time series from 1998 on through I think this goes through 2020, maybe 2021. And so the point is that when you have an asset class like loans, a proper loan has a loan to value of less than 50%, which means there's that much cushion in the capital structure because there's subordinated capital in the form of a high yield bond or equity or some other security that's financing the rest of that company. And so volatility that happens is borne by that subordinated capital first, without having to get too technical. But so what that means is that even when the market gets weak and let's say companies' earnings deteriorate, maybe that deteriorates from 40 or 50% loan to value, maybe it goes to 60 or 70% loan to value, you still have significant cushion. So you get into a recessionary environment, defaults hit, but you still have that cushion, and investors, things get cheap enough, opportunistic investors are going to step in and say, I can buy this company. We can talk about Medline. If Medline had earnings deterioration, but still had that loan to value and you could still get 30, 40% cushion, investors are going to step in and say, this is too cheap. The coupon, the cash flow is too great. As an investor, I can get discount, I can get coverage, I can get cash flow. It's too cheap to ignore, and then people step into the bank loan market. And bank loans are amortizing, so unlike bonds, they are prepayable at any time, and they do have a small amortization associated with it. So not quite like mortgages where you get a lot of cash flow, but you get some cash flow, and that provides sort of a ballast when you get weak periods in the market. So that value is what draws investors in when the market gets weak. And that's why you've only experienced these 2 down years.
Yeah, I mean, I think that's a really important thing that you bring up. Sometimes people say, oh, bank loans, and they think, riskier. But in fact, it's lower risk than high yield because you have assets or you have subordinated debt below you.
Right.
Through the diversity, you can create a portfolio that you think can survive the problems that are out there, like inflation that you're seeing. The floating rate nature, of course, is great in this potentially rising rate environment. And I guess what today, just if you went out and you created a portfolio, what can you generate? What kind of yield can you generate right now for investors?
Yeah, I mean, you can easily do mid-4s without taking a lot of extra risk.
That's and that's in a world with the 10-year still hovering right below 2%, with a lot more duration. That's a pretty attractive spread. May get a little bit more attractive with some volatility.
Right.
And the yield's actually going to go up because if the Fed hikes just at least 5 times, you've got short-term rates or SOFR or whatever it's going to float off of. It used to be LIBOR in the good old days.
You're right.
That's going to at least 1.5, it seems. 1.25, 1.5.
Exactly.
So seems like an interesting place to be. Of course, it's going to have more volatility than maybe some of the higher grade parts of fixed income that are also floating rate. But I think it's going to be a place that could do better than some parts of the equity market this year.
Absolutely. I mean, I think when people ask, is it the right time to buy bank loans or high yield? The question is always, well, where's the money coming from? If you rotated out of equities and you bought bank loans, I think that might actually be a trade that works well.
It works so far. Bank loans are flat. Equities are down.
That's right.
10%.
I think for the next year that could very well be the trade that works. I think coming out of high yield to loans, that's been working too. So loans and high yield are very similar, but as you mentioned, one is senior secured, top on the capital structure, first priority on assets, and the other one subordinated and usually unsecured. It's not necessarily the one's better than the other, but how do you want to play it given where we are in the cycle? I think where we are now in the cycle and where we are in the rate environment, being up in quality, meaning up in security and lower duration given the inflationary environment, I think that makes perfect sense for bank loans. And so, if you have a couple-year outlook, a 2-year outlook, then I think bank loans can work quite well given the environment we're in. And so I think it's one of the better asset classes. And I think floating rate as a whole, as a category, is going to do well too. So that's CLOs and other assets that CLOs are really just a derivative play of bank loans. So those should do well as, in addition.
And they've been both have been some of our favorite assets that we've been allocating to across our different strategies. Well, Robert, thanks so much for coming in. You heard it here first about our bank loan exposure, and we'll catch up with everyone on the next episode. Good luck out there. Thanks.